FunSupermart.com.
How has the region performed year to date and why?
Okay, I think when you talk about Greater China, you're talking about China, Taiwan, and Hong Kong. If you look at the performance of each of these three countries, starting with China, China underperformed year to date, and that's mainly because companies in the material, in the industrial, and the Chinese banks did badly. This is basically understandable. Why? Because we are in the midst of a slowdown both in China and globally, and these cyclical sectors would normally be most affected. If you look at the performance of Taiwan and Hong Kong, those two markets did relatively better. In Taiwan's case, it was the consumer and the tech companies. Again, it was driven by the launch of the iPhones and all that stuff. So the tech companies did generally well. In Hong Kong's case, it was the properties, the consumers, as well as the Macau casino companies that did well. So generally, it underperformed, but it was dragged down because of China.
Going forward, what do you see are the drivers for the region?
I think the main driver comes from the health of the Chinese economy. In the short term, we see the Chinese economy bottoming out either in the third or fourth quarter, and thereafter you will see a gradual recovery. In the medium term, it's about the structural transformation that's happening within China itself. Here, there are two main focuses. One is on the consumerism of China, putting more money into the hands of the people so that they consume more. Second is the urbanization of rural China and the move from east to west, where you want to develop the inner cities within China. So here we are basically looking for companies that will benefit from this move. So here we are looking about insurance companies, consumer companies, infrastructure development that will help develop the inner parts of China. If you look outside China, the other area to focus on is on Taiwan. Why? Because Taiwan is a very good proxy for global recovery. So in terms of drivers, when once global economy takes off, you will see Taiwan tech companies benefiting. And also you will see a benefit of Taiwan companies from the better Chinese-Taiwan ties. Okay? Those are basically the two main themes or drivers for Greater China.
And what are the headwinds that the region faces?
I think the immediate headwind is the uncertain global outlook and the current slowdown that we are seeing within China itself. The key issue here is that, if you just go back in a bit of history, China has been enjoying more than 8% growth since 2002, so more than 10 years they've been enjoying that. And the last big boost came in 2009-10 after the global financial crisis, where they pumped prime a lot. So China is currently suffering from a indigestion from all the strong growth. So there's a lot of excess capacities in the system, and you've got rising costs of production. So what is happening is that you've got companies that are facing rising costs, which means that their margins are under pressure. You also got the problem of overcapacity. So again, you have to sell, so you've got to lower your prices to be competitive. And all this means that companies are facing financial stress. So as fund managers, we are very concerned about this, and we will focus on companies with strong balance sheet. So the key now in investing in China is balance sheet and making sure that the company is financially sound.
Are there any sectors or themes that you are particularly bullish on?
Themes are the urbanization and the consumerism of China. So this would be your consumers, your banks, your insurance companies, because those are all beneficiaries, as well as also some of the exporters that will benefit once the eventual recovery comes into play.
For 2012, your fund has underperformed the benchmark. Why is this so?
Central bank actions have actually been the main market driver in the past 2 years, and investors have actually ignored fundamentals. So as you can see in the first and the second half of 2012, second quarters of 2012, stock markets and individual stock prices can actually move up more than 20% without any change in fundamentals at all. So when little emphasis is placed on fundamentals, value investing becomes effective in the short term, which is the focus of China Value Fund. So with its relatively high exposure into small and medium-sized companies, you will see that the fund's performance is temporarily dragged down by the lackluster stock prices returns of such companies relatively to the large cap.
Do you see this underperformance continuing in the foreseeable future, and will the fund be adjusting its investment strategy or staying its course?
Mainly, the fund manager will stay on its course, because in the past, the decline in the small and medium-sized companies was actually greater during the market slump. But when the investment sentiment picks up and market regains confidence, such stocks have actually greater potential for more significant rebound compared to the larger caps. During weakening markets, investors actually tend to reduce riskier investment. And then that's what drives the divergence between the small and the large cap companies. So when the market becomes less risk averse, investors holding the small size companies to the medium sized companies have more opportunities to reap greater returns. So the fund managers basically will stick to their strong conviction investment ideas, and at the same time they will do what they are good at, which is basically bottom-up stock picking with company receipts, which they do about 2,500 a year.